Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 8th, 2013, and it's good to be back doing market outlook for everyone. Certainly a changed market and complexion. It's been about a month since I've been on sort of a sabbatical. Jeff has done a great job taking over, and I'm going to resume the weekly videos and also the text part of the market outlook. And don't forget, sign up for this free video and the free text newsletter. So we've got quite a mixed market here, and we're going to get into that. Between the key indices, sort of a mixed message in interest rates. There's a, a lot of confusion as to, just how fast rates have moved up versus where the economy is. We're going to get into, those technical patterns and look at a couple key ETFs as well. So first thing, spiders, okay? As you can see, we still are in what we call a weak warning phase. So why is it a weak warning phase? It's a weak warning phase because we still have this rising 50-day moving average. Now, one thing that's sort of been a little bit disconcerting is how we seem to be mostly, right, if you look at the number of days over the last several weeks, we've been closing lower than where we opened, and a lot of the late day market rallies seems to fade. Even that was on Friday, on Thursday, on Wednesday you had a good follow through day, but most of the days, as you can see, we've closed lower than where we've opened. Even on days where we've closed higher, we've closed well off the highs. So that is not a really strong pattern. Nonetheless, we are in this relatively weak warning phase because we're trading under the 50-day moving average. We've made a couple of attempts and it's rejected. So we want to watch this very carefully because a lot of participants are watching this key average. So the question is, are we getting this distribution top, or is this really a pause here for a sharp acceleration to the upside? If we take a look at the weekly charts, you can see we're trading within these channel lines, right? You have still intact this trend line that we've been using since 2009. You can see that this channel line here, you basically broke down and have been following it up and moving just under it right now, but held by another valid trend line, higher highs, higher lows. So the key is here that the recent sell-off and the lows of last week and this trend line are pretty critical. If we can't hold those, we can easily get a test, certainly down to about the 157 or the 150 level, and that's a pretty good size drop down to the 65-week moving average. It's about a 10% drop or so. On the other hand, we can certainly penetrate this 50-day moving average and look for a potential of new highs as well. So it's the short-term price action that we really have to watch. But put it in perspective, look at Nasdaq. The Nasdaq 100, obviously the recovery in Apple from 400 to 500, which by the way we sort of pointed out that that market low and the head and shoulders pattern on Apple is certainly played out as we expected. So that has affected the Qs, which is in a bull phase, accelerating to the upside and strongly intact. So you've got this mixed picture between the leading Nasdaq stocks and the S&P 500. So which one is going to win? Obviously, we got to watch this short-term price action, right? We could certainly have some potential topping action, but nonetheless, it's the short-term patterns that are going to determine how this thing ultimately plays out and will yield the profits that we look for. So in this case, let's see if we can clear these highs. If not, we're going to look to that 75 level. That should be support. If we can't hold the 75 in the Qs, obviously this is now going to be an important failure and probably a test down to the 200-day moving average as well. By the way, the RSIs in most of these indices not pointing to anything very overbought or oversold. Now let's move into the market internals. First of all, sentiment. As you can see, a couple things, and this is fairly divergent. On the daily charts, we're certainly trading over the 200 and the 50-day moving average. However, the 50-day now is starting to sharply decline, even with us trading above it. So somewhat of a mixed signal. Predominantly, though, if we're trading above the 50 and the 200, that's a negative. However, also still in play is the fact that we, on the sell-off, the pessimism got a little bit extreme here. We hit the top of the Bollinger Band, came back inside, still working off, with that sort of meek rally pattern that I showed you, where we seem to get some rallies, but they fade at the end of the day, and marginally working our way higher beneath that 50-day moving average. So I would say here, on balance, this is a neutral. Not much to get out of the daily VIX chart. On the weekly charts, again, we're trading in the middle of the Bollinger Band. Not really very indicative, other than the fact that it's not overbought nor oversold, but we are trading over the longer term moving average here, so that is showing a little bit more concern about the overall market condition. So overall sentiment gets pretty much a neutral to slightly negative reading overall. Let's take a look at the market advanced decline and up-down volume. The McClellan oscillator, which is this top one here, more of an intermediate, couple weeks to a month out, and you can see we got oversold down in here, got above the threshold of triggering a buy after being oversold, and the market basically has been working itself sideways. So not a real powerful move. The signal so far has been neutral. Really hasn't yielded any profits. You got an initial little pop, then a sell-off, and obviously a recovery. So we're about where this signal started, not really all that strong, but nonetheless still working its way higher on an intermediate term basis. I give this more of a positive. On the shorter term, you can see we got pretty oversold and in both advanced declines and up down volume, and we are working our way. Even though we hooked down, we still have plenty more to work our way up in this particular pattern. So these are 10-day numbers, looking definitely a little bit more favorable on the upside. Now, just to go back quickly here, in the spiders and in the key indices, our pivot stack, which is the 2-3-day pattern, because we've closed lower over the last the last day, our floor trader pivot 2 to 3 day pattern is negative. So with the rising 50-day, the sort of positive overall pattern on the indicators short term, intermediate term, it's slightly favoring the bullish side right here for now. But again, it's pretty mixed, because this is pretty much sideways action here. Not really all that convincing after a pretty strong sell-off. So even though it's still on a buy signal and has potential room more on the upside, it's not really great market action, especially on that fact that we seem to be selling off by the end of the day. Now, one of the key clues we need to look at are bonds. So looking at bonds and interest rates here, again, another relatively dicey picture. We're not overbought, oversold on a price basis. What do we have here? What we have is a slingshot pattern here. As you can see, we hit several month new lows in the TLTs, and back in the middle of August, you had this slingshot reversal pattern, which worked really nicely. Now we're getting a test of it in the last couple of days. So we're really looking for this thing to hold the 102 level, and that this would be potentially putting in a double bottom. However, longer term, you cannot deny we are in a strong bearish phase. In addition, if you look at the weekly charts in the TLTs, we are trading beneath the longer term moving average, and this is not a good sign. Overall, the interest rate picture definitely under pressure. The overall liquidity model is on a sell signal, meaning bonds are still a short. However, you also have this reversal pattern. So if we can hold here, you got a nice double bottom to play off of, and what you need here is really good money management and short-term tactics techniques, which you can get from our premium services and our Mish's Market Minute premium service, which keeps track of how to actually play optimally with proper risk and reward these this conflicting pattern here, right? Short term, you got this potential double bottom. Long term, and on the daily charts, can't argue with the negative phase. So trading this effectively, you can basically look to try to trade against these lows and leverage this short-term pattern. On the other hand, be quick to exit, and this market could easily resume its downtrend as well. So what we try to do is pick the situations with the best risk reward and look at the several day setup on top of the longer term patterns as well. Now let's take a look at some of the other interest rate sensitive ETFs. You've got IYR. This is real estate ETFs, and you can see they really got socked as rates have risen. These are the most interest rate sensitive, and you can see we went from 76 all the way down to 62. That's a really good size move, and you can see it pretty much coincided with the topping out of interest rate prices. But what do we have here? We have a very similar pattern that's been playing out in the bonds, which is a key reversal, right? You've got a interesting, what we call slingshot bottom pattern here, right? You plummeted, made new lows, it reversed the next day, closed at the top 25% of its trading range, and have been trading up pretty much since this pattern emerged, and certainly have closed a couple of days above it. But meanwhile, this pattern still intact. The reversal is here. Let's see if we can hold. If we can hold, that'll be most likely mean that the fear of continued pressure on rates is abating. So our most interest rate sensitive ETF, the IYRs, real estate investment, is showing a reversal pattern as well. And Friday's action was sort of mixed, but we did close up 1.8%, far outperforming the overall market. So if this is a clue, it could be that the short-term pattern, that key reversal pattern in rates will play out. Now, to complicate matters a little bit more is the fact that we've got this political showdown both here at home, whether we're going to bomb Syria. That definitely has affected gold. Putin has indicated that he's not going to stand for unilateral U.S. action. At least that's what came across the tape. Let's take a look at a couple of things about what gold is telling us. So GLD, oh, wrong symbol, moved up pretty sharply on Friday with that news. And as you can see, we're in a recovery phase, right? As you know, we were pretty bullish after the real flush. You can see you had a nice volume spike here. And again, what we had was the key reversal pattern, right? The slingshot key reversal, right? New low, at least a 60-day low on the daily charts, closing the next day at the top part of the range and actually making a new low as well. We actually traded this bottom, and of course we're now trading well into a very nice recovery phase, and you can see that the slope of the 50-day moving average is moving up. But what's interesting is you still have rates relatively high, on a short-term basis. Interest rates have moved, and you've got political uncertainty. So you have these two factors that are opposite pulling on gold. Gold, very, very interest rate sensitive, certainly an improving economy, and its play as an alternate currency, not so critical as things are improving, and they are on a relative basis throughout the world. We got some decent economic news, not great, but good enough. However, with the political uncertainty, with Russia potentially challenging the U.S., that's a real wild card, and that's what got you a 1.5% move after a sizable drop on Thursday. So overall improving trend. You got the big flush out of Paulson, who was a huge holder in the gold ETF and dumped a lot of stuff, and here we are moving much higher. Something that may help us determine which way gold may play out is to look at the gold-silver ratio, which I have up here. This is a weekly chart, and you can see what this is silver divided by gold, actually gold divided by silver, and you can see that this is a weekly chart of gold. This is a weekly chart of silver. This one has the ratio of the two with a moving average on it. This is I believe a 20-week moving average. And some of the strongest bull moves we've got in the metals are when silver outperforms gold. And essentially, even over the last couple of weeks, and certainly through this rally, you can see that this red line here has dropped beneath the moving average, which indicates on a relative basis that silver is outperforming gold. And when that happens, as I mentioned, generally speaking, the market indicates that the precious metals are on the move, and if you're on a decent and improving phase, it is a good indication of a stronger trend is intact. So if this is any clue here, and it works out, and these signals, of course, are not always perfect, but overall you can basically make that assumption. Silver outperforming gold, generally occurs in up moves in the metals in general. So they both move up. However, there have been exceptions. So in this particular case, if we have a clue here, it looks like that the issue in gold is that, as you can see, is that this looks like it may play out to the upside. If it does, let's take a look. As you can see, we have some really good resistance around the 150 level, which coincides to about $1,500, which is a good, maybe $150 move up from here. That's pretty sizable. So you have really good resistance. You can see this vacuum on the downside, and this trend line and moving average comes in around the 145 level in the GLD, and the true resistance from price action is about 150. So if we start moving up, you can count on the fact that there's probably international political tension, and it would probably get an extra boost if the pressure on rates is abated as well. But that clue is that improving silver to gold ratio. Well, that's it for now. I hope this gets you caught up. Good to be back from our summer sabbatical. See you next week. And again, don't forget to sign up for this on www.marketgauge.com. And if you want to follow us, find Mish's Market Minute Premium service for intraday alerts and a real-time portfolio. Thanks, and bye for now.